Think about the last time you did something that cost you money without thinking. Mira is 65 now. She retired 4 months ago. The $684,217 she had at 47. That kept growing. She stayed in, didn't panic, did exactly what she was supposed to do. And now the number is $1.1 million. She built the machine ran, she's here. And last Thursday morning, the electricity bill came in. $180. Nothing dramatic. And Mira did what felt completely natural. She opened her brokerage account and sold a few shares. $180 worth. In and out. Simple. But every time she clicks sell, she isn't just taking out $180. She is amputating a small part of her compounding machine. And unlike a lizard's tail, these shares don't grow back. And that one habit, that one completely logical, completely understandable habit, creates a risk most retirees never think about. Not because selling shares is evil, because when you sell them, and how often, and what do you give up every single time you do? My name is Nick, and I spend a probably unhealthy amount of time thinking about money. Not in a portfolio management way, more in a, why do people who did everything right still run into trouble in retirement kind of way. Because here's the thing, most retirement content stops at the number. Get to 1 million, get 2 million, done. Nobody talks about the Tuesday morning when the electricity bill arrives, and you have to decide, where does this money actually come from? That decision, that small, boring, ordinary decision, made every month for 20 years, that's what determines whether the machine lasts, or quietly doesn't. So that's what we're getting into today. Okay, so, let's think about this clearly for a second. You've got £1 million, or dollars, doesn't matter, sitting in a brokerage account. It's invested, it's growing. And now you need, say, $4,000 a month to live. The most obvious thing in the world is, sell some shares every month. Pull out what you need. Leave the rest to grow. Logical, clean, feel responsible. But here's what that logic misses. When you sell shares, any shares, you are permanently removing them from the compounding equation. They're gone. They can't recover. They can't grow. They can't participate in the next 10 years of market returns. You're not just spending money, you're spending future money, a lot of it. That $180 you took out today, if left alone, it could have been $800 or $1,000 by the time Mira is 85. She didn't just pay an electricity bill, she sold a piece of her future security. And the timing of when you sell, This is the part that really gets me. The timing matters more than almost anything else. Sell during a good year, fine. You lost some future growth, but the damage is manageable. Sell during a bad year, when the market is down 25–30%, and you're locking in losses permanently. Those shares you sold at the bottom, they never get to come back. This is the problem Mira doesn't know she has yet. Let me show you what this actually looks like in numbers, because I think when you see it, really see it, something clicks. Two people, both retire at 65, both have $1 million, both need $48,000 a year. David sells shares every month. Systematic, disciplined, feels like a plan. Mira built an income layer. Income arrives automatically. She doesn't sell a single share. Same starting point. Same market returns. Same lifestyle cost. 10 years in, David's portfolio is lower. Mira's is higher, and the gap widens every year after that. David keeps removing shares. Mira's shares stay invested. Now here's where it gets uncomfortable. The market drops 30%. David still needs cash, so he keeps selling. More shares are gone, at the worst possible price. The $48,000 David withdrew in year one didn't just disappear. Had it stayed invested, it could have been worth nearly $94,000 10 years later. He spent $48,000, but he also gave up the future growth attached to it. This is the death spiral. Mira tightened her belt for a year and let everything recover. This isn't about intelligence or stock picking. It's about where the money comes from. Because I can already hear what some of you are thinking. Aren't dividend ETFs slower growth? Aren't I giving something up? That's exactly the right question, and the answer is more interesting than most people expect. Okay, so, let's be honest about this. A pure total market index fund, the kind we talked about in episodes 1 and 2, will probably outperform a dividend income ETF over a long stretch. In terms of raw total return, yes, the growth engine is usually stronger. So why would anyone shift toward income ETFs in retirement? Because, and this is the part that took me a long time to really understand, total return and usable income are two completely different things. Think of it like this. You've got a rental property worth $500,000. Amazing, wonderful. But if it doesn't have tenants, if it's not producing rent every month, you cannot pay your grocery bill with the property's value. You have to sell a piece of the house. You have to start selling bricks, and eventually the roof starts to shake. A growth-focused portfolio in retirement is the same thing. High value on paper, but to access that value, you have to sell it. And every sale is a timing decision. Every sale carries a sequence of risk. An income-focused portfolio is the property with tenants. The rent is arriving. You don't have to sell anything. The asset stays intact. In retirement, the question isn't which portfolio grows faster. It's which portfolio lets you stop making timing decisions. Because timing decisions in retirement are dangerous. Not because you'll make bad ones. You probably won't. Because the market doesn't care about your timeline. It will be a bad year. And if you're selling shares during those bad years, even calmly, even systematically, you're doing permanent damage. The income layer removes that risk. Not complete, but enough to matter. Enough to mean the difference between David's portfolio and Mira's. Rick Ferry, a retired Marine Corps pilot, managed billions in passive strategies, has a line that I keep coming back to. He calls the income phase hibernation, not sleeping, not ignorance, deliberate, structured calm. The portfolio is doing its job. Your job is not to interfere, and the only way you can genuinely not interfere is if you're not forced to sell things to survive. All right, so what does Mira actually do differently? In episode 3, we talked about the 3-tier structure: buffer, income layer, growth engine. I want to go a bit deeper into the income layer specifically, because this is where the stop selling shares shift actually happens in practice. The income layer isn't one thing, it's a blend, and the blend matters. Most retirees who get this right are combining 2 or 3 types of income-producing ETFs. Type 1, dividend growth ETFs. These are funds holding high-quality companies with a long history of pay and growing their dividends. The yield isn't enormous, maybe 3 to 4% annually, but the growth is real, which means over time the income actually increases. It keeps pace with inflation. Your purchasing power doesn't erode. Think of it like a tenant who pays rent and gives you a small raise every year without you having to ask. Type 2, higher yield income ETFs. These produce more income, sometimes 6, 7, even 8% annually. Covered call strategies, preferred shares, international dividend funds. The yield is higher, but you're giving up some upside. In a raging bull market, these lag behind. But, and this is the key, in a flat or declining market, they keep producing income, which is exactly when you need it most. Type 3, the buffer, short-term bonds or cash. 1 to 2 years of living expenses, completely separate. You touch this when the market is having a terrible year and dividend income drops temporarily. It buys you time. It means you never have to sell anything at the bottom. Mira's setup, practically speaking, let me try to make this concrete. She's got $1.1 million. She needs $48,000 a year. She keeps $90,000 in the buffer, about 2 years of expenses, high-yield savings. Don't move. She puts $400,000 into a blend of dividend growth and higher yield income ETFs. At an average yield of 5%, that's producing about $20,000 a year in income automatically. The remaining $610,000 stays in the total market index. Growth engine, hibernation. She hasn't touched it for a decade. The income layer covers $20,000. The buffer covers the gap when needed. She's not selling shares, she's not making monthly decisions. The system runs. The gap between her dividend income and her total need is covered by the growth engine's natural expansion or the buffer, but the core lifestyle is protected by the income. And every year the growth engine quietly compounds, uninterrupted. I want to take a minute here because I think there's something deeper going on than just portfolio structure. When David sells share every month, there's a psychological cost to that too. Every month he makes a decision. Is now a good time? Is the market okay right now? Should I sell a bit more this month because the heating bill was higher? It's a low level, it doesn't feel dramatic, but it's a constant low hum of financial decision-making. And decision fatigue is real. And in bad markets, that hum gets louder and louder, until one day, it's not a small decision anymore, it's panic. The market is a master at finding your breaking point. If you have to make a choice every month, the market will eventually find the month where you are tired, stressed, or afraid, and it will win. Mira doesn't have that hum. The income arrives, she spends the income. The buffer covers gaps. The growth engine runs in the background. She checks it maybe once a quarter. That's not laziness, that's architecture. And this connects to something Rick Edelman has been talking about for years. We are the first generation likely to live well in the past 90. Some of us past 100. If Mira retires at 65, she may need this machine to run for 35 years. 35 years of monthly decisions about whether to sell shares. That's not sustainable. That's exhausting. That's where mistakes happen. Rick Edelman's argument is simple. The 60/40th portfolio, the old model, the safe model, was designed for a 15 to 20-year retirement. Not 35, not 40. The math doesn't survive that long. But a well-architected income system, with a growth engine running in parallel, has a chance. Because it removes humans from the monthly decision. And that removal, counterintuitively, is what keeps the portfolio alive. And look, I want to say something honest here. This shift isn't easy. Not because it's complicated, because it requires letting go of a habit that feels responsible. Selling shares to cover expenses feels like you're being careful, like you're in control, like you're managing the portfolio actively. The income approach feels almost passive, almost too simple. But simply isn't the same as weakness, and passive isn't the same as carelessness. The smart retirees who never sell shares, they didn't get there by accident. They built something deliberately, and then they got out of their way. So, back to Mira. Last Thursday morning, electricity bill, $180. She opened her brokerage account, she looked at her shares, and then she closed it. Because of the income from her dividend, ETFs had already landed in her account 3 weeks earlier, $1,800. Automatic. No decision is required. She paid the bill from that income, the same way she paid the previous bill, and the one before that. The machine didn't even notice. The shares stayed. The growth engine kept running. Nothing was interrupted. $180 bill. 0 shares are sold. 0 timing decisions. 0 sequence risks. That's it. That's the whole shift. It doesn't feel dramatic. It's not a brilliant investment insight. It's not a secret strategy from a hedge fund. It's just, where does the money come from? If it comes from selling shares, you're making a timing decision every single month for the rest of your life. And eventually, one of those months will be the wrong month. And the damage from the wrong month compounds just as powerfully as the growth does. If it comes from income, you're not deciding anything. The system decides. The income arrives, the shares stay, the machine keeps running. Your 65-year-old self didn't spend 22 years building this thing so you could dismantle it piece by piece every month. They built it to run, so let it run. Because the best thing money can buy isn't things, it's the ability to stop thinking about money. So, the same question I always ask, and I do read these. Are you still in the building phase, still focused on growing the number? Or are you starting to think about where the money is actually going to come from when you stop working? Drop it in the comments, because those are two completely different conversations, and knowing which one you're in changes everything about what you should be doing right now. And if this series has been useful, subscribe, because the next episode is going to get into the specific numbers, which income ETFs, what yields to expect, how to actually build the income layer, practically, not theoretically. The architecture is in place. Next time, we furnish it.